Welcome to today's episode of the Investor Dictionary, and today we're unpacking the definition of a term by the name of the Gordon Growth Model. And what the Gordon Growth Model is a very simplistic way of trying to give a valuation of the shares. So if you can do a valuation of what the share is really worth and see that the share is trading at a lower price to what its actual valuation is, then there's a chance the share price will go up. And conversely, if you do the valuation of the share and you see that the share price is trading higher than what the actual value is, then you know there's a good chance that that share price will be dropping. And what the Gordon Growth Model effectively does is, as I said, very simplistically, it makes the assumption that whatever dividend that the company is paying at the moment will be continuing to grow at a constant rate year on year on year on year into the future. And the important factor here is that the value of a company's share on the stock market is what the traders of that share are taking the present value of estimated future profits, estimated future dividends, estimated future income that you'll be receiving from that share. So from the Gordon Growth Model, using the simplistic growth on equal amounts of percentage amounts of growth year on year on year to perpetuity, then what you can then do is you can create a mathematical model that takes those assumed future dividends and the future dividend growth and calculate it back to a figure of what the present value of that future income is most likely to be. And then that in turn becomes, according to the Gordon Growth Model, what the share price at the moment should be, and that gives you a figure that you can compare to the actual share price as it is being traded on the stock exchange. But bearing in mind that this very simplistic model works best for companies that are very well established, your blue chips, that are incredibly well established, that have got consistent income flows, and they've got consistent income flows that tend to grow at a constant basis. The other item that you can use for the Gordon Growth Model for is to value an index of a group of companies over an extended period of time. Those are the two methods that the Gordon Growth Model is most commonly used for, rather than your single speculative high volume newly traded shares. That's my definition of the Gordon Growth Model. Post any comments and questions you might have down below. Don't forget to give this video a thumbs up if you like it, a thumbs down if you don't. Share it out amongst your friends, and last but by no means least, click that big red subscribe button as well. That way you can stay subscribed to my channel for all of the new videos as I post them on a day-to-day, week-to-week basis. Stay carved up for the win. I'll see you next time. Cheers.